Something happened quietly in the last 12 months that almost no one in the mainstream financial press has explained clearly to the people it affects most. And if you are a senior, it affects you directly. The Supreme Court of the United States issued a ruling that fundamentally changed the legal foundation of how the IRS is allowed to enforce tax obligations on investment and asset income for ordinary Americans, not corporations, not hedge funds, not billionaires with offshore accounts, ordinary Americans. Seniors who worked their entire lives, saved carefully, built up modest wealth in the form of retirement accounts, brokerage accounts, and real estate, and who are now, without knowing it, sitting inside a new enforcement framework that the IRS is actively using to generate notices and assessments at a rate that has not been seen in decades. Most seniors have not heard about this. Not because it was hidden, it was covered in legal publications and tax journals, but because nobody translated it into plain language and explained what it actually means for your specific financial situation. I am going to do that right now. I am going to walk you through exactly what the Supreme Court's ruling established, why it matters for your tax obligations in 2026, the 4 categories of seniors who are most exposed right now, and the 5 steps you need to take immediately to make sure you're protected before the IRS's automated enforcement systems find a gap in your return that you did not even know existed. But before I get into any of that, I need to give you the context that makes everything else make sense. Because without understanding why this moment is different from every other tax year you have lived through, you will not fully appreciate the urgency of what I am about to tell you. For years, decades really, there was a legal argument running through the tax world about a very specific question. Does the federal government have the constitutional authority to tax wealth that has not yet been realized? In plain language, can the IRS tax you on money you have not actually received yet, on gains that exist on paper but have not been converted into actual cash in your pocket? That question went all the way to the Supreme Court, and in the Morvis United States decision, the court weighed in on it in a way that sent ripple effects through the entire tax enforcement landscape. The ruling did not eliminate income tax. It did not dramatically overturn the existing tax code, but what it did do, and this is the part that almost nobody explained clearly to regular Americans, is confirm and in some ways clarify the scope of congressional authority to define what counts as taxable income and when it becomes taxable. The decision gave legal validation to a broader interpretation of when the government can treat accumulated or attributed income as reportable, and it did so at exactly the moment when the IRS was rebuilding its enforcement infrastructure with the $80 billion in new funding it received through the Inflation Reduction Act. Those two things happening simultaneously in the Supreme Court ruling that clarified and in some ways expanded the legal basis for certain income taxation, combined with an IRS that suddenly had the technological capacity to actually enforce that basis at scale, created a compliance environment in 2026 that is genuinely unlike anything that existed before it. The IRS is not operating on the same rules, the same technology, or the same legal footing it was operating on 3 years ago. And seniors who are disproportionately likely to have the kinds of accounts and assets that sit in the zone that this ruling touched, retirement accounts with large accumulated balances, brokerage accounts with significant unrealized gains, foreign financial accounts, interest in family businesses and pass-through entities are disproportionately exposed to the enforcement activity that is following from it. The 4 categories I'm about to describe are not hypothetical. They represent the specific situations where the IRS is already generating automated flags right now. The first and most widespread category involves required minimum distributions from retirement accounts. If you are over 73 years old and you have a traditional IRA, a 401k, a 403b, or most other tax-deferred retirement accounts, federal law requires you to withdraw a minimum amount from those accounts every year. That minimum is calculated based on your account balance at the end of the prior year divided by an IRS life expectancy factor. The amount changes every year as your balance changes and as you age. Missing an RMD, taking too little, or calculating it incorrectly does not get quietly overlooked the way it might have several years ago. The penalty for missing an RMD is 25% of the amount that should have been withdrawn but was not, although it can be reduced to 10% if corrected quickly. Here is what has changed and why this is urgent right now. The IRS receives direct reporting from every financial institution that holds retirement accounts. They know your balance. They know your age. Their automated systems calculate what your required minimum distribution should be and compare it against the income reported on your tax return. If the numbers do not reconcile, the system flags it automatically. No human reviewer has to make a judgment call. No audit has to be initiated. The notice goes out automatically, and by the time you receive it, the IRS has already calculated what they believe you owe, including the penalty. What makes this particularly dangerous for seniors in 2026 is the combination of factors that converged over the last several years. The Secure Act and the Secure 2.0 Act both changed the age at which RMDs begin, which caused genuine confusion for people who thought they already understood the rules. Account balances that dropped significantly during market downturns and then recovered created situations where some people thought they were taking adequate distributions but were not accounting for the recovery in their calculations. And some seniors, acting on advice that was correct under old rules but is no longer accurate, have been managing their distributions in ways that are not compliant with the current requirements. The IRS's automated systems do not give credit for good intentions or outdated advice. They compare the numbers on your return against the numbers reported by your financial institution, and when those numbers do not match, a notice gets generated. The second category involves seniors who have foreign financial accounts or interests in foreign entities, and it is catching people off guard at a rate that is genuinely alarming. This is not primarily a story about wealthy tax evaders with secret Swiss bank accounts. It is a story about ordinary seniors with very specific life circumstances, people who were born in another country and immigrated to the United States, people who retired abroad for a period and maintained accounts in the countries where they lived, people who have dual citizenship, people who inherited interests in foreign businesses or foreign property from overseas relatives, and people who maintained small savings or investment accounts in foreign banks during international careers decades ago and simply never closed them when they came home. Every one of those situations carries potential federal reporting obligations that are completely separate from your regular income tax return. The Foreign Bank Account Report, the FBAR, requires disclosure of any foreign financial account where the aggregate balance exceeds $10,000 at any point during the year. The Foreign Account Tax Compliance Act, FATCA, requires additional disclosure on your tax return itself for foreign financial assets above certain thresholds. These are not obscure rules that nobody knows about. They are federal law. And the penalties for failing to file the required disclosures are staggering, up to $10,000 per year per account for non-willful violations and far higher for willful failures. What has changed in 2026 is the IRS's ability to actually find these unreported accounts. Foreign financial institutions are now required under international agreements to report accounts held by U.S. persons directly to the IRS. That reporting is now flowing into the same automated matching systems that compare your filed return against third-party data. If a foreign bank reported an account in your name or social security number to the IRS, and you did not file the corresponding FBAR or FATCA disclosure, the system has already found the gap. The question is not whether the IRS will find it. The question is whether you are going to address it proactively before they send you a notice, or wait until the notice arrives and deal with it in a far more difficult and expensive position. The third category involves seniors who have ownership interests in pass-through business entities, S corporations, partnerships, limited liability companies, particularly in the context of family businesses where the income and ownership structure has evolved over time without careful attention to tax compliance at each step. This is more common than most people realize. An enormous number of American seniors have some form of interest in a family business, a rental property held in an LLC, a family farm structured as a partnership, or a small business that was built over decades and is now in the process of being transitioned to the next generation. Pass-through entities do not pay corporate income tax. The income flows through to the individual owners and is reported on their personal returns through Schedule K-1. The complication and the compliance gap that the IRS's systems are now specifically designed to identify arises when the K-1 income reported by the entity does not match what appears on the individual owner's return, when the basis calculations for ownership interests have not been properly maintained over years of contributions and withdrawals, or when transfers of ownership interest within the family have not been properly documented and reported. The Supreme Court's ruling in Moore touched directly on the question of when income attributed to a pass-through entity can be taxed to the individual owner, even if it was never actually distributed. That question is no longer purely theoretical. It is being actively applied in the IRS's current enforcement posture. Seniors who have been receiving K-1s from family entities for years without scrutinizing whether those K-1s are accurately reflecting their actual tax obligations, and without maintaining the basis records that are required to properly calculate gain or loss when those interests are eventually sold or transferred, are sitting on potential compliance gaps that the IRS's systems are now built to identify and pursue. The fourth category is the gift tax reporting gap, and it is one of the most widespread compliance issues affecting seniors in the current enforcement environment. Under federal law, any transfer of property or money that exceeds the annual gift tax exclusion, which is $18,000 per recipient for 2026, requires the person making the gift to file IRS Form 709, the United States Gift and Generation Skipping Transfer tax return. Filing the form does not necessarily mean you owe gift tax. Most people will never owe gift tax because of the lifetime exemption. But the form is required to be filed regardless of whether any tax is owed, and not filing it when it is required is a compliance violation that carries its own penalty structure. The situations where this is creating problems for seniors in 2026 are varied but consistent. A grandparent who helped a grandchild with a down payment on a house. A parent who gave a significant cash gift to help an adult child through a difficult period. A senior who transferred real property, a vacation home, a rental property, a piece of land, to a family member without going through the formal appraisal and gift tax reporting process. In each of these cases, the intent was generous and completely legal. The money or property was theirs to give. But the requirement to report the gift on Form 709 exists regardless of intent, and the IRS's modernized data systems are now actively cross-referencing real estate transfer records, financial institution reports, and estate filings to identify unreported gifts. When a deed transfer appears in county records and no corresponding Form 709 appears in the IRS database, the system flags it. When a financial institution reports a large transfer out of an account and no corresponding gift return was filed, the system flags it. These are not situations where the IRS is making a judgment call about whether the gift was appropriate. They are mathematical comparisons between what was reported and what was required to be reported. And when the comparison shows a gap, the enforcement process begins automatically. I want to pause here and address something directly because I think it is important for you to understand why seniors specifically are showing up at the top of the IRS's flagged population lists right now. It is not because seniors are more likely to cheat on their taxes than anyone else. In fact, the data suggests the opposite. Seniors are among the most conscientious filers in the country. The reason seniors are being flagged disproportionately is structural. It is because seniors are disproportionately likely to have the specific types of assets, accounts, and financial history that the IRS's new enforcement systems are designed to examine. Seniors are more likely to have retirement accounts with large accumulated balances that are now in the RMD phase. Seniors are more likely to have lived and worked internationally at some point in their careers, creating the foreign account situations I described. Seniors are more likely to have family business interests accumulated over decades of work. Seniors are more likely to have made significant gifts to children and grandchildren in cash, in real estate, in business interests as part of their estate planning. And seniors are more likely to have made all of those financial decisions at a time when the compliance requirements were either different, less strictly enforced, or simply never clearly explained to them by the advisors and institutions they trusted. None of that is your fault. But understanding it matters because it means that the path forward is not about feeling guilty for decisions you made in good faith. It is about getting clear on exactly where your situation stands relative to current requirements, addressing any gaps that exist in the most efficient and legally protected way possible, and doing that before the IRS's automated systems turn a passive flag into an active enforcement action against you specifically. Step one is to actually educate yourself in specific, not general terms, about what the current rules are for your specific financial situation. Not the rules as they were explained to you 5 years ago. Not the rules as your neighbor understands them. The current rules as they apply to your actual accounts, your actual assets, and your actual circumstances in 2026. That means understanding what your RMD obligations are if you are in the distribution phase of your retirement accounts. It means understanding whether any of your financial accounts or interests trigger foreign reporting obligations. It means understanding whether any transfers of property or cash you have made in recent years required a Form 709 that may not have been filed. You cannot take protective action on a problem you have not clearly defined. Clarity about your specific situation is the foundation that everything else builds on. Step 2 is to gather your complete financial records going back a minimum of 3 years, and ideally further if you have had significant transactions involving real estate, business interests, or large gifts. That means your tax returns, your retirement account statements, your brokerage account statements, your K1s from any business entities, any real estate transaction documents, any records of large cash gifts you gave or received, and any documentation you have of foreign accounts or assets. Lay those documents next to each other and look for the gaps I described. RMD amounts that may not have been correctly calculated, K1 income that may not have been accurately reported, transfers of property that may not have been accompanied by the appropriate gift tax return. You are not expected to know immediately whether every item represents a compliance problem. You are building the factual record that a qualified tax professional will need to assess your situation accurately and completely. Step 3 is to bring everything you gathered in steps 1 and 2 to a qualified tax professional, specifically a certified public accountant or an enrolled agent who has demonstrated experience with retirement account distribution rules, international tax reporting obligations, pass-through entity taxation, and gift tax compliance. These are specialized areas, and general tax preparation experience does not necessarily mean expertise in the specific issues that are most likely to affect you. When you contact a potential advisor, ask directly whether they have experience with RMD correction procedures, FBAR and FATCA compliance, and IRS penalty abatement processes. Ask whether they have handled voluntary disclosure situations for clients who discovered unreported obligations in prior years. A qualified professional with this specific experience is worth their fee many times over because the penalties they can help you avoid are almost always far larger than what their advice costs. Step 4 is to create an account at irs.gov and access your tax transcript right now. This is completely free. It takes about 15 minutes to set up through id.me, and it gives you access to something extraordinarily valuable: the actual data the IRS has on file associated with your Social Security number. Your transcript shows every return that has been processed in your name, every third-party report that has been matched to your account, every 1099, every retirement account distribution report, every K-1, every foreign account report, and every notice or assessment that has been issued against your account. Reading your transcript tells you exactly what the IRS sees when they look at your file. If there are pending notices you do not know about yet, they will be there. If there are data mismatches that have been flagged but not yet actioned, they will be visible. This is how you go from guessing about your exposure to actually knowing what it is. And knowing is the only basis on which you can take effective action. Step 5 is to act before April 15th and before any enforcement action becomes finalized, because the difference between addressing a compliance gap voluntarily and having the IRS discover it through their automated systems is not a small difference in terms of outcomes. It is an enormous one. The IRS has formal procedures for voluntary disclosure and amended return filings that allow taxpayers who identify and correct compliance gaps proactively to significantly reduce, or in some cases eliminate, the accuracy-related penalties that would otherwise apply. The penalty abatement process rewards people who come forward before enforcement begins. Once the IRS has generated a formal notice and the assessment process has started, those options narrow significantly and become much more expensive to pursue. If you have already received any notice from the IRS, a CP2000 underreporter notice, a letter questioning a specific item on your return, any correspondence at all from the IRS that you have not fully resolved, respond to it before its deadline without exception. Do not handle IRS correspondence on your own. If the amounts involved are significant, bring it to a qualified tax professional immediately. An unanswered notice does not go away. It escalates through a predictable sequence: proposed assessment, statutory notice of deficiency, final assessment, collection action, and each step in that sequence is harder and more expensive to resolve than the one before it. The time to act is before the notice arrives, not after. Before I close, I have to warn you about something that is just as dangerous as the compliance issues I have described, because the scam operators who prey on seniors are paying close attention to exactly the kind of high-profile enforcement environment I have described in this video. Within days of any widely circulated story about IRS enforcement targeting seniors, the phone calls start. People claiming to be IRS agents, emails with official government seals, mailers from companies promising to resolve your IRS problems for a large cash fee paid upfront. The real IRS contacts you through United States Postal Service mail. Period. The real IRS does not call you demanding immediate payment. They do not threaten immediate arrest over the phone. They do not accept gift cards, wire transfers, or cryptocurrency as payment for anything. They do not send unsolicited emails asking for your personal or financial information. If anyone contacts you with urgency around an IRS issue and asks you to act immediately through any channel other than formal postal correspondence, it is a scam. Hang up. delete the message, and verify any concerns you have about your own IRS account by going directly to irs.gov yourself, not through any link or phone number provided by someone who contacted you. Here is the bottom line, and I want you to hear it clearly. The Supreme Court's ruling, combined with the IRS's transformed technological capacity and expanded enforcement mandate, has created a compliance environment in 2026 that operates by fundamentally different rules than anything you have navigated before. The system is automated, it is comprehensive, and it is specifically calibrated to find the kinds of gaps that disproportionately show up in the financial histories of seniors, not because seniors are doing anything dishonest, but because seniors are more likely to have the specific types of accounts, assets, and transactions that fall inside the boundaries of what the current enforcement systems are designed to examine. The steps are clear. Educate yourself on the specific rules that apply to your situation. Gather your complete financial documentation. Work with a qualified tax professional who has real experience with the issues most relevant to you. Pull your IRS transcript and find out exactly what they already see. And take proactive corrective action before the April 15th deadline, before any voluntary disclosure windows close, and before the IRS's automated systems turn a passive flag into a formal enforcement action with your name on it. You did not ask for this situation. Most seniors who are sitting on compliance gaps right now made completely reasonable financial decisions without anyone clearly explaining that those decisions had specific federal reporting requirements attached. Recognizing that does not change what needs to happen. What changes your outcome is taking informed, specific, timely action while the window to do it voluntarily is still open. If this gave you clarity, please share it with every senior you know who manages their own finances. That one share could genuinely save someone from an outcome that costs them far more than it ever needed to. Subscribe because these updates keep coming throughout 2026. Leave your questions in the comments. Your situation could be the basis of the next video. I will see you there.